Crew resource management. It is critical in aviation and it is critical for the government managing the economy. We're going to talk about that and a little bit of an analogy I have today on open interest. The United Airlines Flight 232 incident, which is often called the impossible landing, occurred on July 19th, 1989. And this is just on my screen right now. I actually have a picture of the accident aircraft. It was an early 1970s DC-10. As a little bit of background, this was a flight that was bound from Denver to Chicago. It had almost 300 passengers and crew on it at the time. At some point mid-flight, when the plane was over Iowa, the plane experienced a catastrophic failure of the tail-mounted engine. If you're looking at this picture, you're going to notice that it's a 3-engine configuration. There's 2 engines mounted under the wings. There's 1 in the tail. And the 3rd engine suffered a catastrophic failure. Essentially, and I'm going to summarize this, so if I don't have all of the details right, just know that I'm a little bit of an aviation buff, so some of this is going by memory. But a turbine fin ruptured the engine case, and when it did, it severed 3 sets of hydraulic lines. So the plane had redundant hydraulic systems, but all of those systems were lost as a result of that catastrophic failure. What that meant was that the flight crew no longer had control of the control surfaces or the flight surfaces of the aircraft. So they could not control the rudder, the ailerons, elevators, or as would later be important, the flaps, and actually even things like the landing gear. I was actually on a 3-engine airplane that also had a hydraulic problem and also lost some control of these things. It was not a DC-10, it was a 727. It was one of the shuttles that was traveling, I think, between Boston and DC. I'm trying to remember where I was going, but I believe I was going from Boston to DC. Now, the interesting thing about this flight and why I'm talking about it is that the crew, and they were aided by an instructor pilot for the airline who was traveling as a passenger, who, as it happened, apparently had spent some amount of time practicing, I believe, in the simulator for circumstances where planes lost all of their hydraulic pressure. But this airplane, the only thing that they were able to control were the throttles of the 2 remaining engines. And that's how they managed to crash land this plane on an attempted emergency landing in Sioux City, Iowa. The captain of the flight, as I understand it, continued to try to control the plane via his controls, the yoke, but apparently they had no effect because there was no hydraulic pressure. And the passenger pilot was controlling the throttles of those 2 remaining engines, 1 in each hand. And essentially they crash landed the plane at close to double its appropriate landing speed, in part because losing the hydraulic pressure also meant that they couldn't control the flaps. Extending the flaps reduces the stall speed of the aircraft at low speeds, which is the reason that they extend them. You've probably seen that if you've looked out the window. Now, why do I bring all of this up? Because in the context of what is going on right now, I kind of feel like that is what policymakers are attempting to do right now. They're attempting the impossible landing. Now, in this case, with the United 232, there was tremendous loss of life. Over 100 passengers died, but actually, like I said, there was almost 300 on board, so more than half lived. Apparently, efforts in the simulator to duplicate this incident, and I encourage you to learn more about it. I think there's some other pictures here. This is on the Wikipedia page. You can see the flight path that the plane had, and a more detailed diagram of the things that went wrong and the 3 hydraulic systems that were severed. And I keep thinking about this as I imagine policymakers attempting at the moment to negotiate their way. And by the way, we had some problems all our own when we were trying to get this thing going. So I'm trying to figure out where my Bloomberg screen is right now, and I'm not seeing it. It's around here somewhere. I may even have to reboot that. But before we get to that, I just wanted to say that, I think about this a lot as I think about policymakers trying to negotiate the current economic circumstance that we find ourselves in. So the U.S. economy right now, we have a debt to GDP that's probably close to 140% debt to GDP. We have a federal budget deficit that is 7% or more of GDP. We have an inflation rate that's around 3%. We'll call it that. Obviously, we'd like to see it a little bit lower. And as we imagine what's going on here, you have and also we have very, very slow economic growth. So the forecast before the most recent FOMC was for 2.1% a year-on-year GDP growth. They reduced that to 1.7. The Atlanta Fed actually had a big negative number. As we think about what policymakers have, they're a little bit like the crew in this airplane. The economy, despite people at the end of last year saying, that it was perfectly healthy, you can't claim that an economy that has managed to double its debt since early 2008, that's running a 7% fiscal deficit, that's running call it a 3% trade deficit, that has inflation that was at 40-year highs and even now has only been reduced to about 3%, I can't claim that that is entirely healthy. And as we imagine what policymakers can do, there are a handful of things that are within their control. So they can control the fiscal policy, right? So you can control taxes, you control government spending, and you can control monetary policy. The problem is that you're trying to solve a whole bunch of things all at once. We know that the deficit is unsustainable. It has to be reduced. There's really only a couple ways to do this. You have to reduce spending, or you have to increase taxes, or some combination of these. And this is very, very difficult to do without slowing the economy in either case. One, because government spending is a calculation in GDP. So if you reduce it, GDP goes down, all else equal. The amount by which it goes down, we can debate that, and multipliers and things of that type. And of course, if you increase taxes, that can also slow the economy. These are, again, the amount is not really the issue, just acknowledging that this is the reality. And of course, using monetary policy to try to stimulate the economy is potentially inflationary. And if you have not already reduced the inflation rate down to a level that we agree is reasonable, this is going to be difficult. And at the same time, they're trying to accelerate the economy. So I kind of liken it to the same thing. It's this impossible landing. Now, the interesting thing about this is that flight also was considered to be an impossible landing. In other words, they did not think that it was achievable, that you would be able to crash land that plane and have survivors. But they did. But the reason that they were able to was because they had crew resource management. That is to say that the entire crew was working together. The captain, the 2 crew that were supposed to be in the cockpit, and the 1 additional one who had been flying as a passenger who joined in. So I guess my point is that in order for us to really pull this out, and if I'm looking away, that is only because I'm trying to find my missing screen, which I don't seem to be able to. I'm not sure where that went. Yeah. Oh, someone just saw it, apparently. I'm being told. So let's see. Can I maximize that screen? Aha! There it is. So, third time's a charm. The crew was working together to make that possible, and it would not have been achieved without that. Here, I liken the situation to one where you have basically the crew, which we're going to refer to as all of the people in government, essentially doing battle with each other, and rather than trying to work together, which I think is really unfortunate. I say all of that partially because I was asked earlier today by somebody in the media what I thought about what the options market is implying for next week's response to tariffs. So the April 2nd is the anticipated tariff rollout, and I just wanted to sort of quickly show where we're at in terms of implied moves and volatility in anticipation of this. So if we take a look, the white line, I'm going to get rid of the red line, which will pop up automatically. So this is the term structure. Now I want to point out, if you're ever looking at the term structure of volatility on whatever mechanism you do it, it is very common for the really short dated, the 0DT options, and that's this part here, to trade at a slight premium. There's just more buying activity that goes on there. People use them as a day trading vehicle. So I'm just going to sort of take those off the screen. And now we're just basically looking out to the end of next week. So this is the implied volatility for the end of next week. And here we are comparing it to the rest of the term structure. And I'm going to pull this up on a tenor basis so we can kind of get a look at what, we'll call it a healthy term structure would look like. This would be the term structure that you would expect to see in a broad market index like the S&P if you did not have a potential market moving catalyst. So this is going to be smoothed out considerably, but there you go. This would be sort of the general shape that we would expect, and this is the shape that we have. Now, if you look at it in this scale, this seems like a really sharp move is anticipated next week. And as you can see, the implied volatility for options expiring on April 4th, that's the end of next week, are closing on 20. All right, so that's for, we've got basically 7 trading days until expiration. So if we figure there's 256 trading days in the year, we can divide that by 7. That gets us to 36.5-ish. And then we can take the square root of that number, and that is 6. So that would be our divisor. And yeah, we can see that this is it's a pretty pronounced, pretty large number. So if we just take, we'll go 19.25, just say that's the number. So that's implying a move of about, that implies a standard deviation of about 3.2%. So that means 68% of the time, the options market is implying that we're going to be within up 3.2 and down 3.2%. And to get the expected move, we take that and we multiply it to get to the mean absolute deviation. I've talked about this before. You can use 0.8. That's about 2.5, 2.6%. Which is, to put things in perspective, that's probably 60 to 70 basis points higher than we would expect, all else equal, in terms of market movement. And that probably doesn't sound like a whole heck of a lot, and I actually don't think that it is. And the reason I believe that's true is because I think that not just options markets participants, but all market participants are probably looking at what's going on here and saying, there's a little more to it than just these tariffs. And I think that's probably what's having an impact. Let me just also quickly show you here what a 7-day realized volatility in this neighborhood would look like in a historical context. So this is 1 year look back on realized volatility over the course of 7 trading days. That's the orange line here. And the white line is what the options market is anticipating through the end of next week. Above average? Yes. Off the charts? Well, clearly not. We can see that over the course of the last 12 months, there have been at least 4 environments, most notably that one in early August where we had that huge VIX spike. and the market sell-off that kind of normalized intraday. But that white line depicts what the market is expecting. So that I just wanted to sort of cover that as we look towards next week and April 2nd and the anticipation of these tariffs. And I have a feeling that part of the concern we're seeing in equity markets is also just related to the fact that it's a really difficult path that policymakers have. This is the folks at the Fed and in the administration. I'm not sure that folks in Congress right now are they're actively trying to manage the economy or anything, but that's that. Okay, so let's see here. Post next week instead of remaining elevated. Oh, see, okay, we've got a question. Why don't we get to that? And I'll try to put it on screen. Again, I have some technical problems with my machine today, so I hope you'll bear with me as I sort these out. So MM asks, if investors are worried, why would vol decline post next week instead of remaining elevated? So that's a very good question. The reason I believe that it's elevated for next week is that we've had a lot of this on again, off again business with these tariffs. And I'm imagining that there are some folks that are just waiting to see, number one, whether they actually are imposed as they've been described, and whether or not governments that would be affected by them will come out ahead of time and say, we're willing to work with you on this. We saw that with India. So India came out and said, we are prepared to reduce or even eliminate tariffs on, I think, 250 imported goods, basically to reduce the impact of tariffs on the goods that they export to the United States. And, if we get something like that, that's going to be obviously a very big positive. I will also say, and I think this is an important thing to remember, the trade deficit we currently have estimated, I'm just going to round numbers here, it's probably close to $1 trillion. I think the numbers that I had seen more recently were something like 4.1 trillion of imports, 3.2, 3.3 of exports, so maybe not quite $1 trillion, but there are different ways you can look at and measure this. In any case, the important thing to think about is that we do need to get that trade deficit down. It would be helpful, of course, if we were able to bring in some revenues, but yeah, I think this is one of the issues. The other thing I would say is that the imposition of tariffs, and I think this was alluded to in Chairman Powell's comments, is that this isn't a secular headwind of ever increasing in inflationary effects. It is, if you impose, for example, a flat 10% import tariff on all goods, that's never going to be as simple as that. But let's just say it was for the sake of argument. A flat 10% import tariff, that would be a step change function, but it would not be a continuous function that would lead to ever rising interest rates thereafter. I'm not trying to downplay the impact of those increases. I still think they're material, but I don't think it would be as persistent in the long term. I think there is a sense that we need to see what's going to happen, absorb what those impacts are, and then adjust to a new reality. Okay, so there's another question here from PC. In one session, you said that you can mentally calculate options prices given an implied volatility and time to expiration. How? Okay, so if you give me an implied volatility for, so it's actually pretty simple. So the straddle is going to be the mean absolute deviation. And the mean absolute deviation, as I previously described, is 0.8%, 0.8 times, or 80% of the standard deviation. So if you know what the standard deviation is for, some period of time. So let's just say we'll use SPX as an example, or we'll use, we'll use SPX. Why not? So let's say that somebody said, okay, the implied volatility for SPX for 1 year is 16%. Okay, so that's the standard deviation. The mean absolute deviation is going to be 80% of that number. So that's going to be 80% of 16 is going to be 10. Let's see, what is it? Well, should be able to do that in my head, but just make sure I'm doing this correctly. Yeah, 12.8, right? So that's the mean absolute deviation. That's going to be the price of a 1-year straddle. So now, assuming that you're using a straddle that's struck at the forward and there's no other carry cost considerations, that would mean that a 1-year at the money call option in the S&P is going to be about 6.2% of the current level of the S&P, right? So $36-ish, 72, something like that. So $72 for the straddle. Now, if you want to adjust that for a different period of time, you divide by the square root of time. What do I mean by that? Well, if you're looking at it for 1 month, the square root, there's 12 months in a year because it's always annualized. So the square root of 12 is about 3.46. You divide those numbers by 3.46. Now you have the price of the straddle for 1 month. You want to know what it is for a day. The square root of the number of trading days in a year is 16. So you divide that by 16. Now you know the straddle price for a day or a week or whatever, right? So that's kind of the back of the napkin way to think about it. A party trick, I guess, for your friends. I'm not sure what other utility it has other than that. In the old days, having a rough sense of this was helpful because we didn't have, in the late 90s when I first started, people traded on sheets. So what that means is that we didn't have a computer pricing these options. We would have an HP12C and a matrix of prices, and we would use those. So that's how you do that. Tucker D. Dog, the vol would go down after the event as the expectation is that the move happens or doesn't, but then the market is at a new level and defines a new normal to some degree. No, yes. So that's also a fair assessment, which is, we call this event variance, which is that if you can assume that there's some underlying volatility process that persists all the time, some normal level of volatility, and then you have isolated instances along the way that cause elevated volatility, isolated events, we refer to the incremental volatility as the event variance. That is the volatility that we associate with an individual event, like April 2nd, the rollout of the tariffs. So that is a way to think about it. Of course, the tariffs don't come and go just that day, the way that earnings do. They come, and then we're going to get some kind of read through. So there's probably going to be kind of a decay rate in that volatility as people adjust to it. Okay, so we can leave that part there, and I just wanted to talk about something else, which is that, obviously a lot of stocks have fallen so far this year. I was looking at this earlier today. The Russell, the Russell 1000, I think I saw something like 550 stocks are lower on the year, so just over half of them, which actually in some ways was a better number than I might have expected. And I just wanted to start talking about a handful of the stocks that I think are beginning to become interesting basically as a result of these declines. And what prompted this was yesterday there was a conversation on Fast Money. I was on Fast Money yesterday, and they were talking about gaming stocks and whether or not China, Macau, all that was going to sort of come back to the fore. I do think that the consumers are under significant pressure in the United States. That has pressured a lot of these names. But there are stocks, I don't know that much about what's going to go on in China. I was thinking to myself, well, if we are able to improve our trade deficit with China, I mean, we have the biggest trade deficit. They have the biggest trade surplus. Presumably that wouldn't be great for them. So I was looking for stocks that still have some exposure to that space, like Wynn, like Las Vegas Sands, and so on, but more domestic. And MGM was one of those names that I had come up with. And so really, I had a list here. I can go through all of them, or I can just cherry pick a handful. I was just looking at companies that, by my estimation, and by the street's estimation too, because obviously I do rely to a degree on what folks are seeing. This one's beginning to look pretty cheap, right? So we're looking at a year-on-year EPS decline. No big surprise. If we can get to the street's consensus of $2.80 a share for next year, that gets us to about 11.4 times forward. I've got a pretty handsome free cash flow yield over the market capitalization anyway. So, it's a 13.5% free cash flow yield to market cap. And if we're just looking at free cash flow it carries a decent bit of debt, as you can see. But if we're looking at it relative to the enterprise value, it's still 3%. So this was just sort of, that's what caught my eye. And I thought, some companies are beginning to look like they're getting cheap. Now, there's good reasons for it. I think I'm just going to run through them in order of sector. And I'm going to start with consumer discretionary because I think this is the area that we're probably most worried about. We're a consumer-driven economy. Consumer discretionary is the stuff that people can pull back on if they choose to. So in the context of trying to land this, to stick this impossible landing, these are the names that have been getting hard hit. So, whether or not you're inclined to go along with some of the trades that names I'm going to bring up in the consumer discretionary space is going to depend slightly on whether or not you think they're going to be able to pull this off at all. But MGM was one. General Motors, this is another really pretty, badly performing stock, but it is, and of course the autos are, right in the thick of it because in many cases the domestic automakers, they have parts going back and forth across the border. I mean, oftentimes, the door is being started in one place, finished in another, and then the car is being assembled in Mexico, and then it's brought back. Kind of a ticklish mess in terms of the tariff picture, but it does seem like the administration is listening to domestic automakers' concerns and saying, look, we need some time to sort this out. It's been hard hit. I mean, this thing is trading at less than 5 times forward earnings. Here, too, very handsome free cash flow yield. Not a great growth story in this environment, but I've often said that there's basically 2 kinds of companies I would think about getting long. The first type is just attractive businesses to invest in. To be considered attractive by my work, it's got to be growing revenue faster than the economy. It's got to be growing EPS faster than it's growing revenues, so substantially faster. So call it 200 to 300 basis points faster than the economy. And then we'd like to see EPS growth at least as good. That's not going to be the case here because the other type of company that I think you can sometimes consider are more cyclical businesses that just get incredibly cheap. And this is an example of a business that I think is starting to get into that neighborhood. When you start looking at businesses that have better than 10% free cash flow yield, are trading in the mid-single digits on a price-to-earnings basis, that's another example. And another thing to think about is take a look at its weakest historical earnings periods and then say, okay, well, let's imagine that we revert back to one of those periods, right? So 2020 was a bad year. Company earned $5 a share in 2020. And 2019 also. So within the last decade, that's trough earnings, as we sometimes call it. It's trading 10 times that number. What's the worst free cash flow the company has generated in 10 years? Again, it's one of these situations where you say, okay, well, maybe this one's worth a look, despite the fact that I know it's got tariff troubles, despite the fact that I know it's not really growing at the top line and it's exposed to consumer, but it's one that starts to become interesting. Now, some of these companies technically are not screaming buys yet, but I bring this up now because I think it makes sense to have things on one's radar and just say, look, when the technical setup matches the fundamentals, then this might be one to get long. So, just taking a look here, it doesn't really matter which technical indicator we choose. You can see it's kind of broken out of the high side. So if you're, trading these moving average envelopes or something like that, you might be short it. But it's not a long way down to get to an area where this would probably be at some sort of a buy juncture. We're probably looking around $48 a share. Things, it's down $3 from here, maybe a little bit less, but it's in this neighborhood that I think it begins to look attractive. Okay, so I already mentioned MGM. I mentioned GM. Deckers, I've previously brought this one up. Similar circumstance. This one has been growing the top line, so let's just take a look at that first. As I previously, whoops, that didn't work. As I previously mentioned, I think it is possibly interesting to think about this one as a pairs trade if you're really worried about getting long consumer discretionary, long Deckers, short XLY, or long Deckers, short Nike, as I previously said. Here too, it's really not trading at a rich multiple, and a reasonable free cash flow yield. I think cash is kind of king in this environment. You have to discount that somewhat, but they have a good cash position, $2.2 billion as of their last quarterly earnings report, and we're looking at something in the neighborhood of a 5% free cash flow yield based on next year. That's over the market cap and over enterprise value. It's obviously substantially better than that, and still growing faster than something like a Nike. So sets up as a potential pairs trade. What else? Some energy names I think are doing. Oh, 2 rate-related questions. Thank you for bringing that to my attention. Let's get to it. Hi, Mike. Love these. Thanks for doing them. The administration keeps messaging about lower rates. Do you think that will happen? And do you have any favorite names based on that? E.g., Home Depot or XBI, the ETF? Well, rates are not up to the administration. They would love to talk rates down. And how can they talk rates down? They can talk rates down 2 ways. One way they can talk rates down is they can reduce inflation expectations. And you can reduce inflation expectations or economic growth expectations by suggesting that the economy is slowing. But you want to suggest that it's slowing without signaling recession. Both Bessent and Trump, when asked, have... Trump said something like, I don't like to answer questions like that. I don't remember exactly what he said. I'm sure you guys can find it, but he was being interviewed, do you think we'll go into a recession? That would bring rates down. And they want lower rates because if you can get rates down, then they can refinance the huge amount of debt that's maturing over the next 3 years, $15.5 trillion, as I've discussed on this live stream in the past, which carries a coupon of 90 bips for the stuff maturing this year, 2 3/4 for next, and 3 thereafter, which is well below the prevailing interest rates. It would be huge. If they could get the 10-year down to 3%, that would save us a tremendous amount, right? So you can think about it this way. If you're refinancing $15.5 trillion and you can save 1%, it's $150 billion of interest expense per year that you can bring down. So, of course, they're going to try to talk rates down. But the problem is that we have not reached our target rate of inflation yet. And if you introduce tariffs, that's... this is why I keep calling it the impossible landing. I mean, it's really, really difficult to get all of the things we want. We want to bring the deficit down. We don't want to tank the economy. We want to get inflation down. And it's a really difficult thing to negotiate all of these things that you need with the limited controls. Because kind of like those pilots in 232, they don't control rates. The Fed does. And I'm not saying they should either. We learned when Burns was chairman of the Fed. I mean, obviously I was too young to know anything about it, but Nixon was definitely in favor of trying to get interest rates down. And Arthur Burns, I'm not going to say he complied, but he didn't really push back on that. And we ended up with a double-headed inflation bout in the 1970s. So I think they're going to try to talk rates down. Of course they should, because it has really meaningful impacts. But there's only so much that they're going to be able to do on that front. Okay, so let's see here. I noticed the REIT O was one stock that went up today. Do you think this is because interest rates would potentially come down if a recession happens? Okay, so if a recession happens, we're almost certainly going to get lower rates. Almost certainly, because there are circumstances where you can have a recession and rates don't come down. The dreaded stagflation. Boy, I sure hope we don't get that. I'm sure everybody shares my sentiment on this one. That is what happened in the 1970s. So you had very high rates of inflation and, moribund economic growth. And that would be a real mess. I'm hopeful that doesn't happen. But like I said, it's a difficult thing to negotiate. Yeah, there's one other thing that's going to impact rates, and that is that, of course, if you issue a lot of treasuries, there's a supply and demand issue. If you issue a lot of debt, then the price that you have to pay to borrow those funds would be expected to rise. I mean, there is a finite amount of demand for U.S. treasuries. This was a criticism, actually, that Janet Yellen had received when she was using very short-term debt to finance government obligations. And that is that because she was only issuing at the front end and not issuing at the long end, that artificially depressed long-term rates. So that if you were estimating what the cost of financing your obligations was based on an artificially low rate, then you were underestimating what the refinancing cost is. There was another problem, which is that if you artificially depressed the long-term rate, which they did because they weren't issuing on that end of the curve, that lowered the financing costs for people who are doing things like buying houses and buying cars. And that contributes to inflation. So using the aviation analogy, and I think I'm pronouncing this correctly, you end up with this phugoid cycle. So you end up in a situation where things are going like this, and you can kind of get behind what's going on. So yeah, I think that is a possibility. I will say though that all else equal, right? So that's one way to think about this. All else equal, if the anticipation of economic growth goes down, then rates should fall. All else equal. What else? If we suddenly saw a sharp uptick in unemployment, it could be that the Fed would act on their dual mandate even before reaching the target 2% inflation or lower, and that could get rates down. And the other thing that can help suppress rates going up too much on the long end was a comment that Powell made at the post FOMC, which was that they were going to slow the pace of the runoff of the Fed's balance sheet. So the runoff on the Fed's balance sheet is not coming from the sale of assets that the Fed holds. Rather, it's coming from the natural maturing of those assets. So if you are slowing the runoff in those assets, then presumably that means you are going to engage in what? Mild asset buying. Not enough to stabilize it at 7 trillion or whatever that number is right now, which you can find on the Fred website, but that you are at least buying some amount of assets to offset a portion of what is maturing naturally off the Fed's balance sheet. And that can help because if you're buying those assets, I mean, in theory, the Fed could create interest rates of zero across the curve. I'm not saying they should ever do that, but they could by simply bidding for all assets going from 0 to 20 years and just say, we will pay a price for any treasury issuance such that it, has an interest rate of 0. That would be a very bad idea and would be highly inflationary. But that's my point. They can control those rates, but to do so would involve policy prescriptions that very few people are going to like. That's my guess. Okay, part 1 of 2, PCS. Given MicroStrategy vol term structure, earlier sold some Jan 2026 calls against it, but bought them back for a profit. Nice. Now I have just MicroStrategy, thinking of selling the January 26 calls. ND. Sorry, what do you mean? What? What? Oh, and buying some. Oh, okay. Well, thought there could have been a different abbreviation. So you own MicroStrategy. You're thinking of selling some long dated, almost leaps, they're not quite leaps, they're 9-month options now, and buying some nearer dated options. Okay, and here's the second part of your question. Also, put implied volatility is much smaller than call implied volatility. How to take advantage in an option strategy. So yes, let's address this second part of your question first. This is related to skew. Bitcoin is positively skewed, as some commodities are. And so that's what you're observing. Let's look at Bitcoin alone first, and I'll use IBIT as a proxy for this. And we can see the skew. Then we're going to see how you can use that to your advantage to put on a strategy. And this is what it looks like. Okay, so, all right, get rid of this one. Actually, here we go. I need to extend this out probably further. Change my surface settings. I want to go out to, I want to go up to, let's go out 2 years, and moneyness I've got up to 150 it says. I don't need this. Well, actually I'll go down to 40, why not? See what happens. Okay. So, we'll get rid of this and we'll draw some lines. All right. So, what you are observing is this dynamic over here. And remember that MicroStrategy has some leverage on their balance sheet. So where you're going to see, and this could actually be thrown a little bit by closing prices, but if you were looking at just SPX, this would basically be a downward sloping line. It would, be more pronounced and shaped where the left side is high, because that's downside risk. People like to buy insurance, and I'm sure they're buying insurance here, but you wouldn't see the right side come up this much. So what does this dynamic create? What it means is that you can buy these, which are at the money call options down here, and you can sell out of the money call options. So these are 50 vol, and the 130s are 52 vol, and the 150s are 55 or 6 vol. What it means is that what you usually see in put spreads in most markets, you will now be able to see in call spreads. So if we can probably take a look at, let's look at SPY first, because I think that's a good example of how the market prices things, and then compare that, what we see there, to the dynamics that you get in some of these other things. So let's take a look. So first things first, if this comes up, 1 sec. Like I said, I apologize. I had to reboot this machine before we got started today. All right, so let's kill this. Trade Desk. If I didn't mention it, this is another name that I think is kind of interesting. It's fallen, I think it's like 57% or something so far this year. This was not a name that would normally be on my radar. I happened to hear somebody on a Twitter Spaces yesterday was it yesterday? Maybe it was the day before, make some interesting comments about this. They were saying, let's imagine that you banned pharmaceutical advertising on television, which has been speculated about because it was something that RFK Jr. had said that he was going to do when, I think before he got nominated. Well, if you got rid of conventional television advertising for pharmaceuticals, then maybe they would need the services of somebody like Trade Desk to try to optimize their marketing and advertising budgets across other platforms. All right, so let's just put SPY in here, and we're going to go through this really quickly and just take a look at how different skews, put skews versus call skews, impact the risk-reward relationship of different trades. So I'm going to construct two very different strategies here. I don't know that it really matters. This is going out to May. So what I'm going to do here is I'm going to put in an at-the-money put spread, 569 put, and I think I covered this a little bit. Let's just go down. Let's go down 5-ish%. So we'll go down to like $27 from here. So that's going to take us down to 5. We'll go down to 545. Why not? Okay. So here you go. So you end up with a $24 wide spread, and you can see that that costs $6.60. And now I'm going to go to the same expiration, and I'm going to turn that into a call spread. Once again, just going to add $24. So that's going to get us up to, this should be a call, first of all. So I got to go up to 580, 93, like this. Okay. So take a look at this dynamic, right? So going out to May 30th, month end, I buy a $24 put spread. I spend $6.60. It's essentially at the money, close very close to 569. And I buy a call spread, same distance, and it costs $12, half of the distance between the strikes. Why is that? It's because of this skew. If you have a lot of put skew, you buy an at-the-money put and you sell an out-of-the-money put at a much higher implied volatility. The risk-reward relationship in this case is almost 3-to-1. On the other hand, if I'm buying an at-the-money call and I sell an out-of-the-money call that has a lower implied volatility, now my risk-reward relationship is 1-to-1. I'm paying $12 for something that can be worth somewhere between 0 and 24 versus paying just over $6 for something that can be worth between 0 and 24. Both of these are making an assumption about a $24 price move in the underlying. So that is something that exhibits a lot of put skew. Now let's switch this up a little bit and look at something that does not have as much put skew. And you mentioned MicroStrategy. I was showing you IBIT. But let's first, let me just put MicroStrategy in here. Okay, so it has this shape. Now let's take a look at the exact same dynamic now in MicroStrategy and see what happens to us then. And what did I do with that thing again? All right. Well, we'll go through this exercise. So here we are. I think maybe I need a new PC, or I need separate PCs running all of these different things, because we got a lot of applications running all at once. Starts causing things to choke a little bit. Incidentally, I used to do that. I had, at one point, in my Cantor Fitzgerald days, I had 3 boxes underneath my desk and 10 screens, and a mechanism to switch between screens. It was very, very clunky, but in any case. Okay, so now we're going to go out this roughly the same amount of time. So we're going to look at MicroStrategy here. We're going to buy an at-the-money call spread. And you know what? Let's just, for the sake of argument, let's just see. What's the, so 330. We're going to use 330, and we'll go up. Let's go up 1 standard deviation. That seems like, yeah, let's see. Does this go? I don't have a May 30th. I mean, the other, this is close. This is very close to the one we had before. So let's just go like this. We'll do something like this. So now we're going to look at a 330-400 call spread, mid-market. And now we're going to do the same thing on the put side. I'll use the same strikes. 330. I want to go down $70, so I'm going to sell a out-of-the-money put. But you'll note, you can see already by looking at this other structure here that that's got to be a put. You're going to see that this relationship is more symmetrical than in the other case. So now notice this. Now we're looking, and because of the skews that we just described with that call skew, you'll notice that the upside call spread is $22 and the downside put spread is $26. So that dynamic that we saw in SPY, where the upside call spread was more expensive than the put spread, has now been reversed, a function of this skew. So what's another way to play this? And we kind of alluded to this when we were on with Dennis Davitt last Friday. That is that you could just take an in-the-money spread and just take a look at what zero extrinsic value would provide. So I'm getting $17 of extrinsic value that I'm selling on this 400. So that's how much I'm going to be willing to pay in terms of extrinsic value for my in-the-money call. I'm going to just look at an in-the-money call. So I'm just going to quickly go and say, okay, well, what strike has roughly $17? 285s. Let's try this. So I can take this down. I'm going to get an in-the-money call spread now. And we're trading 330. Okay. So now I've got a trade that has some asymmetry. There's basically no extrinsic premium here. It's basically an in-the-money call spread. But notice now what the dynamics are. So I have downside for so there's essentially not much decay on a standstill basis. The break even is approximately right where we are right now, very close to it, 332.5 based on current prices with the stocks around 330. So we're talking about 1% difference. We're splitting hairs here. Well, just observe what's going on. You have downside to 285, which is $45 worth of downside, and you have upside to 400, which is $70 worth of upside. So if you thought it was just a 50-50 shot that the thing could move $70 in one direction or the other, you have an asymmetric risk-reward relationship. That's one of the things you can do when you get this call skew scenario. Interestingly, I was observing that you could collar NVIDIA. So if you have a long-term position in NVIDIA and you're just a little bit shaken up here, you can get asymmetry putting a long collar on your NVIDIA position where you have more upside than you have downside risk. And you can hold on to your stock. So again, pay attention to these skews, absolutely. Now, I would also observe that in MicroStrategy's case, because there's leverage on the balance sheet, the more leverage they put on the balance sheet, the more you should start seeing some skew increase to the downside, right? Because that's just a fundamental reality. The more levered the balance sheet is, the more levered the equity is, the higher the implied volatility is going to be, all else equal, for a dollar change in enterprise value of a levered balance sheet. I have a $1 billion company, and that could be all equity, it could be all debt, or it could be some blend of these. If the value of a $1 billion business declines by 15%, that's $150 million. If the balance sheet is levered 50% debt, 50% equity, the equity is first loss. That's going to decline by 30%, not 15%. If there's a lot of cash on the balance sheet, by contrast, then it would be less. So the skew is going to be a function, in part, of balance sheet leverage. So as MicroStrategy layers more debt in, now they're doing preferreds, which are a hybrid now, instead of the zero coupon converts. But this is something to pay attention to. And actually, from my perspective, if you were going to buy downside puts and sell upside calls, collaring up a long position in MicroStrategy, for example, you're going to, that the volatility dynamic of those two options positions you possess should improve as Michael Saylor takes on more debt. So the second question, so that was the second part of the question. The first part of the question, you are trading Vega for Gamma. Okay, so the other thing you were talking about was short a long-dated option and long a short-dated option. So, I shouldn't shrink those screens down because when I do that, that's when I tend to lose it. So I'm going to just bring that back and I'm just going to cover it up with my Bloomberg screen and just move these things back and forth. So now The next question we're interested in, that's a term structure bet. So we want to think about that a little bit. How do we feel about the term structure in Bitcoin? Oops, I have Bitcoin. I should probably be looking at this in terms of MicroStrategy because that's more specifically what you were looking at. So now I'm going to look at the term structure and say, okay, so you're selling long-dated options to buy near-dated ones. I don't know if you just observed something there. You'll notice that as you go further out in time, this sort of shifts down, whereas generally speaking, it's going to be upward sloping. It's kind of an interesting implication there. Basically suggests that at some point, the volatility of the asset class is likely to decline, because remember, they're taking on leverage over the course of time. So if you assumed that that was going to continue apace, then you would also expect that equity volatility would at least remain constant or rise, all else equal. So this must also be an assumption that Bitcoin volatility will come in a little bit over the course of time. That's going back, that's almost 2 years from now. That's D's 26. Okay, so you are selling this option right here. A little bit of a dip there. You see that? That's interesting. So anyway, it looks like descend might be slightly more attractive. How much of a difference is that? So 84.5 versus, oh, it's only 30. It's only 30 basis points. It's not a huge thing. So if you are short long dated options, you are short Vega, which means you will benefit from a decline in implied volatility. If you are long near dated options, you are long gamma, which means you're going to benefit from a lot of near-term volatility. And that's not a bad position to be in, but it certainly will depend slightly on what your expectations are. If you think we're going to really chop around in the near term, then and that eventually things will settle down, then that's the trade you want to be in. You know, one could even think about putting on like some sort of a term structure fly. Yeah, I would just point out that the Januaries, you might not be the only one who's thinking about this, because it does seem like there's a little bit of a dip in implied volatility there. Let's just take a look at how that pays off. Yeah, oh yeah, someone's just getting into my ear and pointing out that some of what you're observing could be a function of, you know, wider bid-ask spreads, end of day pricing kind of thing. So let's just take a look and we'll construct the strategy that you're talking about. I'm going to get short January 26. Let's just go with something like the nice round number, 375s. So we're going to get short those 375s, and then we're going to buy a near dated option against it. And you're going to see, sell those. Actually, I should probably put this a little closer to at the money, because that'll make the graphing work a little better. Okay. There. So this illustrates perfectly this sort of long gamma dynamic. If you are long gamma, what you want is you want near-term volatility. And you can see that if it just lingers here, that doesn't work for your strategy. But if it makes a good size break for it one way or the other, up or down, then you win. So it's a little like being long a straddle, long a strangle. If you are short a calendar, in the same way that when we put on long calendars going into earnings, hoping for the vol crush, what we're expecting and hoping is that the underlying is not going to move well outside of its expected or implied moves, and you're going to benefit from the collapse of near-term volatility. And this, of course, is going to be the exact opposite. You are helping to finance the purchase of near-dated options by selling those longer-dated ones, but you know the decay rate of near-dated options is going to be greater. So you need movement for that to win. But I mean, I think that's a fine strategy. It's interesting, that term structure. Like I said, you know, we used to have in the futures world, when people would talk about doing flies in futures, you might do something like sell the front month future, buy a shoulder month future, and then sell a subsequent future. What's a shoulder month? Like if you're trading natural gas, tail end of the withdrawal season, you're concerned that maybe natural gas suddenly takes off because there's a near-term shortage of supply. So you buy that with the tail end of the withdrawal season future and then sell the two around it. So you're not going to be making so much of a bet on the level of natural gas per se. You're making a relative play that there could be a short-term supply-demand imbalance in that particular period. You would do the opposite during the injection season if you suddenly think that there's going to be an excess. So you want to be short the future at the tail end of the injection season. This is a similar kind of a trade where, if you got long, say, 2-year options, short 1-year options, and then long and near-dated option, you're trying to mitigate the vega exposure. So the whole surface can rise or the whole surface can fall, and you're trying to play off of that. And especially since the longer-dated ones do appear to be trading at a lower volatility. There's backwardation from about a year on out. Okay. Let's see here if there's got some... Be sure if you have any additional questions, be sure to drop them in here. I wanted to get to some of the other names that I had identified. Oh, we're already at an hour? Wow. Okay. I'm going to just punch through a bunch of stocks that got onto my radar as things that are beginning to look, net of the pullback, net of their growth rates, net of their multiple, are beginning to get attractive. So you want a better technical setup. But these are, I'm just going to start listing some of these companies, and we're going to take a look at their charts, see what the technical setup is, but I'm just going to point out that they're starting to look more reasonable on a fundamental basis. So where did I end this? Deckers. Okay, so next one. Diamondback Energy. Energy actually had been one of the outperforming sectors anyway, but let's just take a quick peek here. So I'm just going to go like this, and let's take a look at what the chart looks like. So this was one that I thought might be interesting. Down on the year, valuations beginning to look interesting. So that's Diamondback, ticker FANG, FANG. Western Alliance Bancorp, I can understand if you want to stay away from that. Financials have been doing reasonably well, but how about a Northern Trust? So Northern Trust is a huge asset manager, if you don't know, Chicago-based. And they are, you're dealing with the ultra high net crowd. You can see it's fallen off fairly considerably since the peaks earlier. It's down probably, was down about 15%. Looks like it's gotten a little bit of a bounce back. But this is another one that I thought was beginning to look interesting. Oops. Oh, did we get that question? Where did I leave my... I'm going to ask... I lost my question, so I'm just going to let one of the producers tell me. What is the question? It's about UNG, apparently. All right. And you can just read me the question because I cannot see it, whatever thing you're trying to show me. Okay. Yeah, so here we go. So first of all, I just want to show you this, which is the UNG chart. Injection season obviously would be a period of higher demand, although it's not wild yet. So let me see here. This is another one of those ones, by the way, that you can see this. Commodities frequently will have a slightly different skewness. So I would actually say now these funds, they do impose a little bit of a roll cost. So whether it's U.S. oil or U.S. natural gas and so on, because what they're doing is originally they were only trading NYMEX futures. They have subsequently expanded the instruments that they're trading, UNG. So they trade swaps and things like that. But they're, the ongoing machinations of maintaining the fund have some cost and therefore decay. But I think something like a put spread collar is probably the way that I might be inclined to try and play this. Let's see. And this is, let's get that in here. So we've got probably support around that $18 level. And that's, there we go. Okay. Et voila. So something along these lines, I think, would be a reasonable way to play this. Selling the support level at around $18 or so. So that's kind of the level at which you'd be interested in, because it's not at the tail end of the injection season, that's when you can get real gross oversupply dynamics. This is also kind of a longer term play too, in part because, although you probably want to play it through Cheniere or something like that, with respect to our potential for exporting liquefied natural gas. But I think the dynamics are generally fairly good, so I might use a strategy like this. And tune in on Friday, because I did sort of chew through a little bit more time, I guess, getting into the weeds on some of those other things. Let me just list some of these other companies that I think are going to be worth a look. We're not going to really have time to blow through them right now, but I will touch on them a little bit more on Friday, but I thought it'd be kind of interesting. United Rentals, ticker URI. Broadcom. NVIDIA has that pigs in a python type of thing, but the thing's sort of been more abundant here. Vistra Energy, so that was another one that I think is kind of interesting here, as the AI trade kind of rolled over. American Express. So American Express is going to be less sensitive to things like consumer distress and delinquency. Number one, they have more charge and less of the credit cards. That's the first thing I would say. More creditworthy borrowers, they skew to a higher demographic. That's not to say that they wouldn't be affected by a slowdown in discretionary spending, because that's going to reduce their transaction fees. But I don't think they have too much to worry about in terms of potential credit risk for their customer base. It's a different group than you get, say, at a Capital One. So I think that one is also potentially interesting and worth a look. State Street, that's a custodian bank, by the way, so if you want to be in financials, no leverage there. It's just kind of a potential benefit, and that one is down on the year, so that might be worth a look. I guess that one way to think about it is kind of like reverting to something safe, like a consumer staples would be in the financial world, to the extent that you can. Northern Trust and State Street probably qualify in that kind of a category. Still exposed to financials, but lower risk. So, like, subscribe, notification bell, and all that kind of stuff. Be sure to put any questions into the comment section for this video if you're watching it and weren't able to put them into the live chat. So if you're watching a recorded version of this, put them in the comment section. And we'll go into some of these stocks in greater detail when we do the live stream at 2 o'clock on Friday afternoon. And, every market's going to provide some opportunities. For the most part, I try to pick stocks on the long side, and hopefully we can identify some that'll be of use to all of you. Thanks for watching.